These are four of the best growth-focused ETFs in Canada, and especially when combined, they make for a great, well-diversified portfolio. So without wasting any time, let's get right into it. This is my experimental retirement portfolio, where I'm trying to build up a brand new portfolio from scratch by investing only in ETFs, and specifically only in these four ETFs. And in today's video, I'm going to break down for you what those growth ETFs are and the percentage of the portfolio that I've allocated to each one, as well as walk you through a little bit of my rationale for why I think this is a great, easy, invest on autopilot retirement portfolio. So let's break down what these ETFs are. I'm going to start with the largest position and then work my way down from there. And the first one that I want to talk about is this ETF. It's XUU, or the BlackRock Canada iShares Core S&P US Total Market Index ETF. Now, what that means basically is that it's just an index that tracks the total US stock market, including all of the big companies, as well as some mid-cap and small-cap companies. My target allocation within the portfolio for this ETF is actually 50%. And the reason for that is the US stock market is basically the benchmark for global economic success. So if the US market is doing well, then this ETF will do well and my portfolio will do well. And if the US market is failing or not doing well, then realistically speaking, it's probably likely that most other places around the world are also not doing well. And so if the US stock market fails completely and this goes to zero, we're all screwed anyways. So that is the reason why this is such a high percentage allocation in my portfolio. And most professional money managers tend to suggest that clients invest pretty heavily in the US before looking at other markets around the world. Anyways, a couple of reasons why I like this ETF specifically are that it's got a very low management expense ratio, management fee of 0.07% per year. So that's great that it's so low, because it just means that more of the growth compounds into the investment. And over time, if that management fee was, let's say, 1%, that would eat away a lot of the potential gains. Another few reasons why I really like this ETF is that it's got net assets under management of $2.3 billion. So there's a lot of liquidity, and this ETF is traded regularly, so you won't ever have any problems in pulling your money out of it if you need to. And also, it's very well diversified across the total US market. It's got over 3,600 companies held within this ETF. So when you buy one share of XUU, you're buying tiny fractional amounts of 3,653 companies, which is great. And since the goal with this portfolio is to allocate 50%, I'm going to buy one share today to try and keep this as close as possible to my target amount. So there, we've done that. Okay, next on the list is VCN, and this is kind of similar, except it tracks the total Canadian stock market. This is the Vanguard Canada All Cap Index. And so the idea with this one, again, is that we're going to invest in all of the largest companies in Canada. The management expense ratio here is also very low at 0.05%, and it's got assets under management of over $5 billion. So there's going to be a decent amount of liquidity there. And the reason why this ETF is in the portfolio, because the Canadian market is not exactly the same as the US market, and it's more heavily focused on companies like in the financial sector. There's a lot of big banks in Canada. In the energy sector as well, there's a lot of oil and gas companies and solar energy companies. So the energy sector is pretty big in Canada. And then of course we've got natural resources and industrials. So there is a bit of a different focus to this ETF than to XUU. And it means that during different times, this could outperform the US market, and of course vice versa, depending on which sectors are doing well. The target allocation in the portfolio for this is actually 25%. And we're sitting a little bit low right now at 21%. So I'm going to buy two shares today and bring that up closer to the target allocation. All right, so the third largest position in this ETF portfolio is VIU, and this tracks the global developed markets, excluding some countries, for example, China. Now, the management expense ratio of this one is a little bit higher at 0.23%, because it costs a little bit more for the fund managers to purchase stocks and equities from all different countries around the world. But it does have assets under management of $2.8 billion, which is solid. And when you buy shares of the VIU ETF, you're buying shares in 3,887 companies around the world. Some of the largest companies in the developed world. And when I say developed countries, we're talking mainly about Europe and the Pacific region, although there's a smattering of other companies, for example, in the Middle East. But if we look specifically at which countries. We're talking Japan, UK, France, Switzerland, Germany, and so on and so forth. So these are well-established, developed economies with some of the largest companies in the world. And the reason why I chose this ETF for my global market exposure as opposed to some other ETFs that might include countries like China is that I don't like to invest in countries where there is that geopolitical risk, where the Chinese Communist Party could, for example, rug pull some companies and you never really know what's going to happen with your equity investments. These are much safer plays. These are all countries that are more or less allied with the United States, with Canada, and so we can expect that there's rule of law, there's property rights protections, and that by investing in these companies, you don't have to worry about risking your capital quite as much as if you invest in some places like China. And so with VIU, I'm rounding out my exposure to global companies, and the target allocation for the portfolio is actually 15%. So it's sitting in a little bit higher than what it should be, so I'm not going to be purchasing any more shares of this one today. And the final ETF on the list, rounding out this all ETF growth portfolio, is ticker symbol ETC, which is the Evolve Cryptocurrencies ETF. And what this ETF does is it gives my portfolio exposure to both Bitcoin and Ethereum because it merges them both together into one product. And that's why I chose this cryptocurrency ETF as opposed to choosing a Bitcoin or an Ethereum one separately. I like the fact that it merges them together. Now, it is a much smaller ETF with assets under management of only around $30 million, but the reason for that is that it's holding in its underlying assets other ETFs that are holding Bitcoin and Ethereum at a weight of 66% Bitcoin and 33% Ethereum. Now, when I introduced this into the portfolio, my target allocation was 5%, but I've actually decided to increase my risk a little bit and bump that up to 10%. And the reason for that is that I'm young, I'm still very far away from retirement, and I think there is still some very solid potential in this sector. And so right now, since we're coming in a little bit below that target at 7.77%, I'm gonna buy 2 more shares today. Now, the reason why this is a growth portfolio and all these ETFs are growth ETFs is that I'm only investing in stocks and of course a little bit of cryptocurrency. But as I get older and closer to retirement, the plan would be to shift some of this allocation into more fixed income assets. For example, bonds that just pay a steady yield over time that you know they're not gonna go up a lot, but they're not gonna go down a lot. And when you need to rely on this income for living in retirement, then you don't want to have so much money parked in equities. But since I'm far away from retirement, the strategy now for me anyways is to focus on growth and then to gradually rotate that over. But what about if there's a market crash? What is my plan for this retirement portfolio? Well, I already alluded to this a little bit at the beginning, but since this is a long-term time horizon that I'm looking at here, it doesn't even matter. In fact, I would actually prefer if there was a market crash today because it would allow me to load up on more when I'm young and very far away from retirement. And by locking in a lower dollar cost average now, I could have a much larger snowball effect as this compounds over time. And that's the beauty of an investment strategy like this. It's basically on autopilot. You only have to log in maybe once a month or every couple of weeks. Whenever you have some spare cash to throw at this, you buy a couple of shares, you try to keep the portfolio allocation close to what your targets are, but you don't really have to think about it. You don't have to check the price every day. And you know that in the long run, since this is so well diversified, because we're talking about almost 10,000 companies worldwide that are held within these ETFs, as well as those 2 cryptocurrencies, you know, this is a very well diversified portfolio. And I have no worries about the price action in the short term. I'm only focused on building up my share count in these ETFs over time. Anyways, that's it for today's video. I'm going to continue bringing updates on this retirement portfolio as we go on. I'll show you how it's performing and I'll bring you any updates if I decide to modify any of the percentage allocations at all. But this is exclusively always going to remain an ETF only portfolio. See you later and have a great day.